The thing I love most is how about we empower you to take control of your cash instead of giving it to a third-party insurance company, right? Hey, welcome to another edition of the Rojas Report. I'm here with my good friend Collin Krickl from the Bastion Group, sitting in the beautiful Dallas, Texas. Dude, are you in Dallas today? It looks like you are because you got
I'm
that
in
picture
Fort
in the
Worth.
back.
I'm in Fort Worth.
Of course
today.
you are. Look at that cowboy rodeo art behind you.
Kind of fitting, right?
Yeah. Okay, so what trouble are you causing today in Fort Worth?
We are having a Leon Capital executive leadership meeting. So we're getting together to talk about strategy for 2026. And as you can imagine, insurance and medical malpractice and healthcare is a massive piece of what we're talking about.
Dude, I love it. All right, so
Yeah.
listen, usually I have physicians on, and so I want docs to hear from you about medical malpractice, about property coverage, about, I think I said medmal already. Which one do you want to start with? Which one do you want to talk about first? Which one's on your mind?
I think what you and I spend the most time talking about is medical malpractice.
Okay, let's do
property
it.
is actually becoming easier to handle, but the medical malpractice seems to be a challenge as exposures are changing, whether you're operating athletes or you're operating a surgery center. That's always seems to be the topic that you and I seem to gravitate towards.
Yeah, well, I don't know if we're going to talk about athletes today. That might
Good.
be off the
2.0.
table. Yeah. Let's have that discussion later. Yeah. Okay. So look, the audience today is 60, 70,000 physicians. What do we want to tell them about medical malpractice? I think one of the things you ought to highlight is they don't know that you can be self-funded. Like they have no idea. Like they think you have to pay for a premium. So I think maybe we start there.
Yeah, so my background is I'm
Yeah.
a property casualty broker. I am part of a family office, Leon Capital Group, that owns and operates 12 operating companies, many of which are in healthcare. So we have 5 physician-owned operating companies, physician-centric operating companies that are in mental health, oral surgery, cardiology, and a number of other areas within the healthcare space.
Yeah,
I
you
was
got
brought on.
you got a heart hospital somewhere, don't you?
Yes, sir. Yeah,
Yeah.
no, it's South Texas. Yep.
South Texas. Yeah.
And so I was brought in to build out an insurance brokerage as well as create insurance products to bring our clients, our portfolio companies closer to insurance products. And one of the tools that we've been using within the medical malpractice space is a captive. Not necessarily a group captive where you're sharing risk or pooling risk, but a self-insured single parent captive that allows you to take on tranches of excess liability as well as, self-insured to the retentions on the higher deductible plans. But within each state, everything, as you guys know, it's all regulated by the states, the medical malpractice boards, and some of the regulation tied around medical malpractice claims. And so we've been building out and creating products around medmal within a national presence as well as a single state focus.
Which states are, like you and I are working on something in Kansas, Louisiana, Texas, Arizona. What states are hard to deal with?
California, New York. You have some
Typical.
challenges in Florida. The typical states that are hard to operate in,
Yeah.
we find, there's always need for alternative strategies rather than paying the $2 million of premium year over year. There's ways to take on risk within your balance sheet via a captive insurance company that allows you to capture underwriting profit.
And most people don't even know what a captive is. So let's start there. What FiCap Fund invests with clinical precision. We are the new venture capital for healthcare. At FiCap Fund, we invest in entrepreneurs rethinking care delivery. We invest early in technology that simplifies physician workflows, enhances patient care, and drives operational excellence. Our network of experienced physicians, healthcare professionals, and executives validate innovations in real-world clinical settings. Physicians Capital Fund, investing in healthcare simplified. To invest, email info@ficap.com. What is a captive insurance company?
It's an owned insurance company. Then it's typically owned by the operating company that has the operating exposure. So the enterprise risk that you're underwriting within the captive is typically tied to the operating company that is employing the physicians, conducting the procedures, and carrying that medical malpractice liability.
So
what we do is we create an insurance
Go ahead.
company that we file with the regulators. The regulators approve it. There's an element of shared risk that we create within a pool of excess liability shared tranches to meet regulatory requirements. But at the end of the day, what you're looking at is I have to insure to $10 million for medical malpractice. I want to own and underwrite my own $5 million of that $10 million I need to carry for my enterprise risk. And we'll create structures that alleviate the lender requirements, the landlord requirements, regulatory requirements, and we'll create structures that allow you to take that $2 million that you'd send off to a third party and try and capture $500,000 to $600,000 of that into a captive that, if you perform well, is now turned into an asset rather than a liability.
Yeah, I think that's something that, I mean, at least 90% of the docs I talk to, they don't know the difference between a premium and a contribution. And they certainly don't know that you could actually own something. So that was one of the surprising things when you and I started spending more time talking about this topic was doctors don't know. What do you like? What do we say to them? Like, how do you teach them these things and say, listen, you were paying an expense, which does nothing for you. You can also build your own. What do you say to them and how do you explain it?
So I look at it as, the third party carrier. What you're doing now is you're paying a premium year over year, and you're going to have to fight for claims. You're likely going to carry a very large deductible, and you're going to have to pay it out of your operating cash flow in order to manage the claims that come in, and knowing that you're never going to get the money back. What a captive is, it's your own risk financing tool, where if you have claims come in, you can manage your deductible retentions through the premiums paid into the captive. And as long as you're performing well, you're operating a very tight organization from a risk management standpoint. You're following the policies, procedures. You are managing your claims yourself rather than relying on a third party to mitigate and close claims and adjudicate claims. It gives you control. And so I guess to circle back on what your question is, the best way to describe a captive to physician is it gives you control and ownership of a large tranche of your risk with your own risk financing vehicle. And the added benefit on top of the premiums that you can capture through underwriting profit is investable returns. So as those premiums sit in your own insurance company, a sliver of those assets can be invested and generate an interest income, whether it's money markets or short-term investments, depending on where you create your insurance company and the exposures that you're underwriting in your captive. Your asset is growing, not just paying claims or being paid out and off the balance sheet the moment the cash leaves and is never coming back.
So why is this a good idea for doctors who have been in business, let's say 8 or 9 years? Why is this kind of the optimal time for them to do it?
The key to really creating a profitable insurance company is actuarial data. If you have a long historical track record of no claims to minimal claims to claims that are not really hitting your insurance, but you show 2 or 3 deductible layer claims on your medmal, your rates are still going to go up. This allows you to control and underwrite with historical information, because the biggest risk is you don't have the data, you start taking on risk, and all of a sudden you have a large claim in your early years that you weren't aware of and didn't have built into the actuary report, which is always going to be there, but there's ways to build excess. But having historical data is key, and that's where the 8-9 years of operation gives you a runway to understand what your claims would look like, what your historical performance is, and build that into an actuarial table.
So what I heard you say, because this is all really good insurance information, I took something that I was paying for as an expense. In other words, it was going out the door and I was never seeing a dime of it. And instead I get to keep it. And I get to manage it. And doctors are generally good at following instructions. I mean, you watch a spine surgery, you watch a heart surgery. I watched a brain surgery the other day, which was pretty amazing. Guy literally cut another guy's head open, right? And he's working in the brain. And I'm thinking like, oh, these guys are really good at compliance. They're really good at following the rules. Like step 1, cut the brain, cut open the skull. And I'm going like, oh my God, I'm going to throw up. But like if you were thinking, can someone follow instructions? Yes. And who better? What? Like one of the things that always probably kind of dumbfounds me is, how do doctors not know this stuff? Like they just don't know that they could they just assume they had to pay a premium. And now all of a sudden they're coming to you going like, wait a minute, Collin's helping me get 30 or 40% of my money back a year. Give me a freaking break. And then they're building enterprise value. All right. So that's building a captive. That's moving from premiums to contributions. In other words, building your own asset. So we talk about medmal. What's the optimal size? So let's say I've got a nice multi-specialty group. There's 200, 300 of us. Is that the right size, or can I start with 10?
You can start with 10. But if you have a group of 10, it's not going to be a single focus on medical malpractice. You would look at bringing in enterprise risks from property to uninsured litigation, loss of key employee, key contract issues that you may want to consider like a trade credit. You lose a big contract or payor, you can insure unique risks that'll accumulate multiple large amount of premiums. So you can't insure layers of the medmal, but at a group of 10, you can create an enterprise insurance structure that encompasses more exposures. The bigger the group, you can create a single monoline insurance captive, but you need that risk distribution amongst a large pool. But on the smaller groups, there's equal amount of value, if not more value, because you can bring in other risks that you can't buy insurance policies for on the open market or are not manageable from a price standpoint with what the underwriters will give you.
Okay, so now I'm going to go two ways. One is you and I are working on a larger captive for lots of participants, for physicians to join and become part of the medmal captive. That's one. But now what I'm hearing you say is they literally a smaller group of 10 or 15 docs, and there's about 10 employees to every doctor. So they could have another captive that's really multi-line insurance. And now all of a sudden I could buy insurance for other things that I couldn't really protect myself against, but now I can do that.
Yes.
Can you tell me more about that? I mean, this sounds fascinating.
We call that an enterprise risk captive. And there's a lot of benefits to it that I don't go into regarding tax and certain specific things. I'm the insurance side of that formation of the entity. And what we look at is we look at the operating company. What are you uninsured for? What are the risks that keep you up at night that Lloyd's of London or even Travelers or the local regional insurance carrier will not underwrite? Because one, it's expensive to underwrite. It's difficult from an actuarial table, but as an operator, it could impact your business. Like you said, you have a large contract with a hospital or a vendor even that you know that you may lose a contract for, call a supplier for our shoulder joints. So if you're an orthopedic surgeon, you may be losing your contract because you're not hitting specific metrics. You can insure the loss, the financial impact of that contract going away, which is a giant differentiator for a lot of businesses. If you can protect the downside, knowing that 3 years out, there is uncertainty, depending on the underwriting and actuarial ability, you can create insurance products tailored towards your enterprise risk, which is not found anywhere else outside of a single parent captive.
So what we could do is when we're talking to physicians and we're talking about captives, you and I can have a conversation with them that says, hey, let's take a look at all of your risks. And you and I can sit down and you can identify those with different physician groups and say, here's the 10 things that you mentioned in our conversation that I think we could hedge against. And we can do that by building an insurance products for. So I think one of these things was, no, we won't mention the client's name, but somebody had an ACO, right? I think, and you said, goodness gracious, we can protect against the negative side of the ACO. An accountable care organization. They were a primary care group. They're making a lot of money on these VBC contracts, but they couldn't afford any downside risk. And then they weren't insured against it. And I think you said something to them about like, hey, we could help you with that.
Yeah. And I think the conversation always starts,
physicians must lead, period. Who's in charge of healthcare? Not physicians. And that's the problem. Physician-led healthcare for America, PHA, is fighting to put control back where it belongs, with the people who actually deliver care, independent physicians, surgical centers, and real competition. Not bureaucrats, not health systems. If you believe in physician autonomy and genuine patient-first care, it's time to step up. Join the movement at physiciansled.com because healthcare needs leaders, not followers.
We are a full-service insurance brokerage, so we can place all your medmal. We review your contracts as any good insurance broker would. We're looking at who you're operating with, where the revenues are coming from, look at the contracts, understand where's the inherent risk. And yet, the way we structure it is we create an actuary table. We work with the actuaries, we work with the captive managers, we work with the regulators to create insurable risk. And as we were having that conversation with that client of ours, it was more of a, what keeps you up at night? And what keeps you up at night was the loss of that. And as you think through it, it isn't an easy cut, paste, repeat. You go to ChatGPT, create an insurance policy. You have to create something that is an insurable risk that meets the definition of insurance, that is approved by regulators. So what we did is we dissected the challenge piece by piece with the regulators, with the insurable risk component, with the structure of the policy. And by doing that, we were able to create, I don't know if it was the first of its kind, but it was really a truly scripted insurance policy that came from an idea and a comment coming out of the client, which was an extremely satisfying and successful engagement.
Yeah, I love that. Okay, so one of the questions I have before we go is, you and I talk a lot to ambulatory surgery center owners and to physician-owned hospital owners. There are more of them that I want to get together with you and I. What are some things that they need to think about? Because their chief complaint to me is property. Hey, one was in Florida, was like, oh, I got a property problem. One was in Oklahoma, like, I can't get insurance. My insurance dropped me. What do we say to them, and what can we do for them? And is it better if we mix them all together? Like if there's 200 physician-owned hospitals. Can we put them all together, and then can we put ambulatory surgery centers in there? Like, kind of what is the solution you're kind of considering in your head?
So first thing for property, and I'll tell this to everyone I talk to, there is no silver bullet. The property market for the last 5 to 7 years has been very challenging, especially in the Gulf Coast, especially within specific areas of healthcare on the general liability and then the property coverage with wind, hail, named storm. However, the way we've looked at property within a captive, there are specific lines or deductible layers and gaps in coverage within the property policies as they're written. Whether it's a wind hail deductible that's extremely high or limitations and sublimits within specific areas of flood, burst pipes, third-party liability. What we look for is mainly a gap coverage on the property. And there's a way to share risk. However, we do need an aggregated group of data sets within a distributed area across the country. So if my comment to all of your relationships around the country that have that property comment is we need to act together and act in unison in order to drive costs down. There's an element where the captive can participate in it, but I'm going to get a little technical here. Within a captive insurance policy, typically you're going to want to see a large amount of collateral. And that, from taking out the technical insurance term, you put $1 million limit in an insurance policy, you pay the premium. You also have to post an additional $1 million line of credit, which is not optimal for an operating company that wants to keep lean balance sheet, cash flows, optimized strategy. Having $1 million tied up for something like that is not optimal. But as you operate together and you have a distributed risk around the country, there are ways to share specific areas of risk through each individual group's captive. And there's a layer of collateralized reinsurance that we can create to offset that large cash burden by getting a large pool of physician-owned captives that have the same challenge in different parts of the country.
That sounds...
And it's creating your own risk distribution across the country by collaborating.
Yeah, and it's the one thing physicians, certainly as I've traveled over the last 25 years, it's the one thing they can't do. They don't like collaborating. But your advice to them is, hey, if you work together, we're not asking you to not compete against each other as orthopedic surgeons or neurosurgeons or whatever you are. But what we are saying is, hey, if there's 40 ASCs, you're going to do better sharing risk than you are if you're just a standalone in Joplin, Missouri.
If you're standalone in Joplin, Missouri, you have no risk distribution around the country. That underwriter is going to look at the last few storms, the hail potential, the wind potential. But if you've got or acting in coordination with 17 other groups in Kansas, in California, in Iowa, in Boise, there's a way to create an underwriting table that actually reduces your risk to the reinsurance as well as the carrier. That is meeting your lender requirements, that is meeting your compliance that you have from XP, which is the reasoning you're buying insurance.
What are, like, in closing, what would you say to some doctors like, hey, I've spent now a year with Dutch. Here's what I'm kind of seeing in the marketplace. Here's the opportunity for you to go from being a, whatever you are today, a partnership. Here's how you're really going to build some enterprise value. And most importantly, here's how you're going to reduce expenses. What are the things you're kind of seeing in the market today?
I'm seeing a massive trend in people feeling disconnected from the product, whether you're buying employee benefits, property, medical malpractice. My thesis around how Bastion Insurance Group is differentiating is bringing the client closer to the product, giving them control. The lack of control, the lack of transparency, and the inability to affect your rates is a massive problem. And what we're seeing is a strong desire to get closer as the consumer of an insurance product and a enterprise risk need to protect your balance sheet and hedge the volatility that we've seen over the last 10, 15 years in property and casualty insurance. And a captive is one of them. There are other solutions that we could talk about and spend probably 12 hours here going down a rabbit hole of a lot of really large technical insurance jargon that no one will understand. But my advice and walk away comment would be, give yourself control. No one wants to be out of control of their costs, their expenditures, and how their business is operated. Why would you allow a third-party insurance company to adjudicate your claims, manage 100% of how your claims are held? Nobody wants a hammer clause in their medical malpractice. I can guarantee that. No one wants that. Why would you allow it on every other policy where the carrier gets to dictate how things are managed, how things are operated? That's what my takeaway would be, is give yourself control. Captive is one of many solutions, and always looking for a new strategy to dissect and mitigate and finance your risk.